Good morning.
Morning, James.
How are you? All right?
Very well, thanks. How are you doing?
Good. So thanks for doing this again. As I said, it's not that long ago that we were talking about the trust, but I suppose we ought to, for those who weren't tuning in then or maybe can watch it back, just do a sort of brief introduction to the fund and then talk a bit about what's been going on over the last 6 months.
Absolutely. Thank you. So the OIT is a vehicle that we launched 4.5 years ago, albeit I'd run a previous investment trust called Strategic Equity Capital for about 7.5 years prior to that. Our objective is very simple. We want to try and make people money rather than beat an index. And the goal we try and set ourselves on the yardstick is to try and double the NAV per share every 5 years, which is equivalent to 15% per annum. And our view is, look, if we can achieve that, I think we'll have very, very happy shareholders if we can compound that over the long term. Now, we do that by investing using our basic skill set and mindset from operating for many years in private equity. You can see the team here. It's basically myself, Ed Vilhofsky, who runs the fund with me day to day, and also Ian Armitage, who's the chairman of the manager. And you can see from the background a couple of things. Firstly, we've got a lot more experience in private equity than we have actually quoted, albeit, you know, for me, it's actually more quoted than unquoted. For Ed, it's more unquoted than quoted. It's in small companies where we tend to hunt. And we've also, as you can see from the shareholdings, got a lot of skin in the game. Between the three of us, we own about 10% of the trust. So we're not benchmarked. If we perform anything like the index, it's pure fluke. And there are a whole bunch of things we do that are different to many of the other broader peers that invest in small caps. So we're pretty concentrated. We tend to have a maximum of 20 holdings. Over the last few years, it's been about 18. And we're looking for companies that have particular attributes that make them attractive for our investment style. As you can see from the slides coming up, we've had, we think, a pretty good run since we launched the trust in May 2018 and delivered a very differentiated performance in what's been a very, very difficult investment environment. The portfolio turnover is pretty low normally, but interestingly, over the last few years, we've had our returns augmented by significant M&A approaches for companies in our portfolio. The thing that we think is interesting about this is not that we pick stocks because we think they're going to get taken over, but we think it's the outcome of our process if the companies we invest in don't get valued properly by the market. What we're looking for is companies that basically are undervalued today, that are decent companies, but also where those companies can be improved and be worth more, even if markets don't go up. So think about it as a lot of self-help in the portfolio. We're sector focused when we look at these companies, and you know, we think we bring a lot of experience of seeing not turnarounds but performance improvement opportunities in various sectors. So we can look at a company and say, I don't know, it's making 8% margins. Actually, all its peers make high teens margins. The company is not priced for any improvement margin. There's an interesting opportunity there if the company can get to generate that higher return. So we spend a lot of time, you know, benchmarking companies against international peers, looking at what international peers are valued at, and then trying to work out actually why the companies are underperforming a margin and what needs to happen to change that. It could be that a company actually is making okay margins, but it's like a mini conglomerate, and if you were to break the company up, it would achieve a share price way in excess of the current market price. So we look at all these different anomalies and then come up with a portfolio of holdings that we aim to hold for at least 3 to 5 years, assuming no takeover of the whole company. Why do we do it in small cap? Well, we focus on companies around sort of 100 to 1 billion, really the sweet spot's 250 to 500. That's where we find a really nice blend of companies that are big enough to get good management teams, but small enough to be off people's radar, and also where research coverage is quite poor. We tend to also find that they're quite nice bite-sized acquisitions if the market doesn't value them properly, either for trade or private equity buyers. You know, there's many more buyers for potentially a £500 million business than there is a £5 or £6 billion business. The thing that we really look for again is at the bottom of this slide, this favorable risk reward for every investment. So we want to find a company where we think there's a very, very high chance of making a 15% annualized return. The prospect for upside above 15% per annum, but actually where there's a very low chance of losing money. So the way we think about risk is actually what's the prospect of making a capital loss in this investment, and we want that to be negligible. And that's quite similar to a private equity way of thinking, where out of, if you go and speak to a buyout house that has 10 investments, they'll be looking to minimize the two loss-making investments, the impact on their portfolio. So that's really a quick summary of what we do. We're sector focused. The vast majority of investments are in the specialist industrials, TMT, healthcare and business services sectors, as you can see from this slide. We have one investment in financial services currently, which is Curtis Banks, which is subject to bid interest at the moment. When you look at the size of the market caps, you can see the vast majority of portfolios in our core area of 100 to 1 billion. And we've got a couple of things slightly smaller, and we run with cash as well. The cash position is interesting. It's very different to many other investment trusts that effectively gear up a diversified portfolio. We haven't used gearing in this strategy for very, very many years, and we like having a cash balance because it provides us the opportunity to buy blocks of stock when they come up without being forced to sell something on the other side. So last 6 months been a really interesting time in the markets. It's quite well reported that many open-ended funds, UK equity funds, have had outflows and have become forced sellers of stock. That's fantastic for us running a closed-ended fund where we're not buffeted by outflows, and we've just literally waited for lines of stock to come along from a distressor and bought them at, we think, pretty attractive prices. So having that cash balance means we could be hunting a line of stock or waiting for 3 months. The day the call comes in, we've got cash to buy it.
Have you got a borrowing facility? Can you actually borrow money if you want to?
We don't have a borrowing facility. The trust can, I think, technically borrow up to 10% of NAV, but we've never done it.
Okay.
There was debate in February, funny enough, and I'm normally quite skeptical for our strategy whether we need it or not. And normally, whenever anybody starts to ask about borrowing facilities, it's normally a sign the market's about to roll over. and I think my approach at the time was, well, let's go and have a cup of tea and think about that. And then obviously Ukraine happened, and it's not been raised since.
Fair enough. The question here is would you gear if markets got really cheap? If you said somebody had a really hard landing and markets come off dramatically?
Maybe. I think the challenge that we have as a relatively small trust and a boutique is it's quite difficult to get borrowing facilities actually of any reasonable duration for these vehicles, unless you're part of a big stable and they'll do it as the banks will do it as a favor because you're a £200 million trust, but actually they've got a facility on 3 other £1 billion trusts. And look, my experience, the history of SEC quite well, James. We did have a borrowing facility there at one point before I began managing it, and just at the time when markets were cheap, everyone wanted to take the gearing facility away. So look, I think the other thing is, if you look at the long-term returns, we've proven we can generate really, really good performance just by stock picking without needing to go and get leverage.
Cool. Okay.
So this is quite an interesting slide. The perception of UK small companies is everybody reads about how bad the UK economy may get or how difficult it is at the moment, are we in recession or not. And if you invest in a typical UK small company, you can see on the right-hand side, almost 2/3 of revenue are from the UK if you buy the index. Now, if you look at our portfolio, it's very, very different. Only about 1/3 of revenue is actually generated in the UK because we really like investing in niche market leaders for whom the UK is one market, but actually the majority of sales might be elsewhere. A couple of examples, Euromoney, which we had in the portfolio until its takeover in the summer, generated 90% of its profits in dollars, largely from North America. ZAR, one of our biggest holdings at the moment, I think it exports pretty much 99% of what it makes, and Huntington probably a bit more. So the fact that it's UK listed, you know, the UK economy has a very little impact on the success or otherwise of that business and its value.
Okay.
So we've got a number of themes in the portfolio. To go through these just briefly. So we've had a question come in about industrials. Yeah, we don't invest in any industrial. We're very, very specific about the types of industrial companies we invest in. If we take the two examples here, Elementis and Flowtech, these companies have gone through periods of under management even prior to COVID, and we've invested in these companies because we think even if the world gets quite tough, there are lots of things going on under the surface in these businesses, which means that they should be, you know, they should have relatively resilient earnings. And not only that, we believe the shares of these companies have basically already priced in some pretty bad news. I think in the case of Elementis, we had a slide in our quarterly presentation in Q3 showing that it was trading on, I think, 0.6 price to book. The average price to book over the last 10 years is 2. So the market's already taken a very, very, very pessimistic view of the prospects of that business. So we're in these companies because actually we think, you know, yes, the world's going to be quite tough, maybe, but actually there are things that the management team are doing to actually improve and defend the profitability of those businesses. And in the case of Elementis, they are shifting production from one of their AP Actives antiperspirants businesses from America to India. That plant's being certified at the moment in India and started to produce in small batches. That will save the company $5 million, which is about 5% of the underlying EBIT. I think the other thing is if you have the right industrial companies that sit in the right positions in their supply chains where they don't have many competitors, they have tons of suppliers or they control their supply, and they have tons of customers, they're in a very, very strong position to put pricing up. And if you look in the US equities in the 1970s, through a period of quite a lot of economic turmoil and inflation and stagflation, the industrial sector was the third best performing sector in that period after energy and minerals. We had a slide on this a few times ago. And the industrial sector generally in the UK is very, very underowned. You know, many small cap managers over the last few years have put a lot of money into TMT investments where ratings were very, very high. And these stocks generally are pretty underowned. Because they're international as well, they tend to have quite a lot of industry peers that are much bigger and trading overseas. And we think the ratings these companies are at, because they're listed in the UK, are way below their intrinsic value. So we think there's some quite interesting potential M&A upside from these stocks as well. That leads into electronics, which we technically class industrials, but the demand drivers of these companies are quite different. So Xaar, which does the inkjet printer head products, the real success of that business over the next 3 to 5 years is about their new product launches. They launched their most recent one a few weeks ago called Aquinox, which is their first product that can print using aqueous liquids, so water-based liquids rather than solvents. That has the potential to significantly increase the addressable market for Xaar, way above what the impact of a slight industrial downturn is going to be. And on a 3 to 5 year basis, frankly, what happens in the next 6 months is just irrelevant for Xaar and its long-term valuation creation opportunity. Dialight's a similar but different story. For those of you who are listening that followed the story over a number of years, it went through a period of significant management self-harm prior to COVID, and effectively has spent the last few years sorting itself out. The core product there is industrial LED lighting, and the real growth opportunities are twofold. Firstly, there are many industrial sites, and they tend to focus on heavy industrial sites such as oil and gas and petrochem. Many of those sites are still using sodium halide products or alternative fluorescent products, and the energy savings of moving to LED are very, very significant. And in a world where energy costs are going up, the ROI and the payback is very quick for this, probably a couple of years at most, and these products last for 10 years. So the economic sell-in for transitioning is very, very high. On top of that, you're starting to see a replacement cycle coming on where clients put these products in 8 to 9 years ago and are looking to upgrade. So we think the prospects of that business over the next 12 to 18 months look pretty good, and very little is in the price there. So again, it might have some softening of underlying demand because of the economic environment, but actually there are some pretty strong drivers for both those companies, which mean they should continue to do pretty well. We've got investments in the two big sectors, B2B media. Euromoney was our biggest holding there prior to the takeover. And there are a couple of common characteristics here. Firstly, these companies tend to be small mini conglomerates and tend to be mispriced by the market. And in the case of Euromoney, it was actually broken up by 2 alternative PE bids. We see equivalent discounts at Wilmington and Essential. Essential's a relatively new holding. The other thing they have in common is they have reasonable events, face-to-face events businesses, and those businesses were quite badly impacted during COVID. But we were very confident that the world would return to wanting to go back to face-to-face business events, and those businesses are doing and recovering much better than I think people had anticipated. There are also assets that we know private equity and trade buyers have been pretty active in the past. And again, if the market doesn't value those companies properly, we think probably somebody else might. The final big area is cybersecurity, where the majority investment is in NCC Group. Again, another mini conglomerate. The company's got pretty strong underlying growth drivers for its cyber business. But in case of NCC, it's that growth opportunity and that value is somewhat hidden by another division they've had there for a very long time. Their original core business, which is software escrow, and that has lower growth, and we think that's holding back the rating. NCC has appointed new chief exec quite recently, who is much more, we think, focused on the cybersecurity business. So we wouldn't be surprised if that company was broken up over the next 3 to 5 years. And as anybody knows,
is it a takeover target?
As it is at the moment, probably not, James, but there are probably different sets of people who would quite like either part of the business. And I think it's not the stated ambition of the company to break itself up, but if you look at the people around the table, we won't be surprised if that's what the outcome is one day.
Fair enough.
And then we've got a couple of other small holdings. The most notable one, or the biggest of those, is Curtis Banks, which, as I mentioned earlier, is a SIP administration business which is subject to a bid. Cool. We had a question about consumer exposure. Nothing. The only thing that was quasi consumer was Devro, which was one of the 2 major providers of collagen sausage skins in the world, which is currently subject to a bid from a European industrial partner. So we don't invest in pubs, leisure groups, bowling or retailers. It's a sector that historically we've struggled to make as good returns in, and quite often, if we're looking for assets that potentially have a trade bar at the end of the day, there aren't that many people other than Mike Ashley that tend to consolidate the retail sector, and Mike Ashley's really someone that's going to put a strategically high price on an asset. So there just aren't as many opportunities, we think, for protecting the downside in that sector.
Yeah. Okay. I think this is interesting. Good. All right. Let's move on to the takeovers, because this is the sort of interesting bit. We have had a couple recently. It does feel like it's sort of picking up. I suppose there must be lots of international investors casting an eye over cheap British companies, given what's happened to sterling and stuff.
Yeah, absolutely. This is not a great surprise, I have to say, James. I mean, the thing that's interested us, or the thing that's interesting about this slide, and this is the completed deals or the pending one in the case of Devro, where there's been a bid. We haven't put Curtis on here yet because whilst it's in talks, there's been no bid tabled. But what you can see here is virtually all the bidders are trade buyers that have been bidding for companies in our portfolio, and the virtual overseas, which again supports this narrative of the UK equities in generally are quite mispriced, and as in cheaply priced compared with other equity markets around the world. I think the other interesting thing is, James, a number of these takeovers came in when the markets were still quite buoyant. So I think it is also an indication that we're pretty good at finding companies that are unloved by the stock market that potentially somebody else would value more properly.
Yeah.
So and where we have had PE interest here, Clayton, WA Rice or Astorg and Pyrrhus or Treat, these are good PE houses. These are not sort of bargain basement hunters as well.
Okay, cool. Now this slide is about approaches that you mentioned a couple of the Elementis ones already. Yeah. But one of the ones on the bottom here is RWS, which was also on the previous slide as well. Now this chart is really about how cheap the markets are.